Management coming in on the show. We come to you live from the CNBC-TV18 Motilal Oswal studio. It's Tata Consumer, which reported a largely in line set of numbers in the fourth quarter. The EBITDA beat estimates despite gross margins compressing by 420 basis points. We have with us Sunil D'Souza, who's the MD and CEO of the company. Thanks a lot, Mr. D'Souza, for joining in right now. The most important thing that the street wants to know this time around for the next 1 year is what is your target on the margins? You've said that if tea prices were to normalize, you could see margins normalize as well. The question is, what is that normalized level? And secondly, what's your expected target for Narishco, Capital Foods and Organic India in FY26? These three numbers, if you could provide us.
So Mangalam, we had a good quarter in line with our expectations, actually slightly ahead of expectations. As to your question on forecast for FY26, double-digit revenue growth is a given. We've already come to volume growth across all our businesses this quarter. We have every single business growing on revenue as well, 17% top line, 12% organic. EBITDA margins were a bit soft. And if you look at it, overall EBITDA, I was a negative 1.1. But here's the thing. The primary compression has been because of tea prices, which have run up 25 to 30%. We've absorbed about 50% and passed on about 50% of the prices. So two things are going to happen. A is we're going to continue to take calibrated price increases as we go forward. But also as the new crop comes in, if it is normal, we expect tea prices to start coming down. That will aid margins. Just as a perspective, while we say margins are going to improve, if I took off both the cost and price increases that we took on tea this quarter, I have improved my full year by 80 bips. Our guidance is for improvement of 50 to 100 bips every year on EBITDA margins, and that doesn't change. As regard the question of starting with Narishco, about a year back, we had pressure from competitors who went in with significantly higher retail margins. No changes on consumer price, which was 10 rupees in Tata Gluco Plus. And we had to recalibrate our retail margins. We did that. And we rejigged our distribution system, etc., to the new reality. And it's coming back very strongly. Actually, we exited March at a 38% volume, 26% revenue. And for the quarter, it was 17% volume, 10% revenue. So it's back on growth. We do expect it to come to 30%. And there's no reason why. The Himalayan business, which is premium, grew by 29%. And Tata Copper, our water business, grew by 23%. So largely on track. As regards Capital Foods and Organic India, the good part is we finished the integration. We've taken synergies out. We understood the business. And I would underline that because it took us about 4 to 5 months to understand the nuances of the two businesses. Different product, different buying cycles, procurement, supply chains, marketing. And now I think we are in full control. This quarter, I think we delivered some decent numbers, 213 crores of Capital Foods, 109 on Organic India. Actually, if you take growth rates, it's 80 and 40 plus in the two businesses, but that's because we had soft quarters last year in Q4. But we feel pretty confident of delivering 30% growth going forward with a focus on distribution expansion and innovation and portfolio expansion as well.
Okay. Hi, Mr. D'Souza. Good morning and good to see you. When I wanted a couple of other points. On the international business, what kind of a growth are you guiding for? On a blended basis, last year's growth was better than what the street was working with. So that's good. For this year, what will international business look like? And what is the targeted ROE? It's still in the mid-single digits. So where do you see that headed?
So the international business, the good part was for the full year, I think we delivered a 5% top line and a 21% EBIT growth. And broadly, the business is back on track. We've always maintained a mid-single digit top line and EBIT margins being accretive to India, accretive to our total business. We did deliver a 5% growth and EBIT margins were 300 bips higher than where we delivered the rest of the business to be. So it's fulfilling what it's supposed to be. The UK business is a standout. We are number 2 tea business now and on a very strong margin profile and overall structural balance. Canada, of course, has come back. It's always the jewel in the crown, very steady. This thing. The US business was a bit of topsy-turvy with the coffee prices, etc. I think that's come back on track. We had 2% volume, 4% revenue growth, and we've announced a price increase starting June with the coffee prices, and therefore even the margins will come back. So international business, again, mid-single digit top line and EBIT margins accretive to the total business is what we would guide for. On the ROE basis, it's a choice to make. I could stand still on acquisitions, and therefore, as I grow my top line and EBITDA ahead of margins, I will improve EBITDA, my ROE, ROC margins. In fact, before we did the acquisitions, if I'm not mistaken, 4 years, we had gone up about 400 to 500 bips on ROC. So we could do that. But we are geared for the longer term. We will grow organically and inorganically while making sure we are focused on both top line and profitability.
All right, we take that point. And final question before we let you go, Mr. D'Souza. One is the target share of revenue that you expect from new products. You launched 41 in the last financial year, 41 in the previous financial year as well. So what proportion of your revenue is currently coming from products launched in the last 2 years? What's the target here? And secondly, there is a slowdown in Tata Starbucks. Do you still maintain targets of 1,000 stores? And have you scaled back on the pace at which you are investing in Tata Starbucks? Comment on Tata Starbucks as well as innovation in products.
So on innovation in products, Mangalam, innovation is key to any FMCG business. And we do aim to be in the top tier of innovation in the food and beverage and FMCG space. Last year, FY24, we delivered 5% plus. FY25, we delivered 5.2. We aim to continue that same trajectory going forward. So you could expect one launch every week as we go forward. That doesn't change. In fact, we will try and accelerate that, if anything. On the Starbucks business, we remain focused on the long-term guidance of 1,000 outlets by FY28 doesn't change. We remain committed to that. It's just that I think I said this earlier also, we will calibrate depending on market conditions. The simple thing that I use is a quote from one of my bosses earlier. Emerging markets is a snake in a pipe. Directionally, it's going up, but it will yo-yo up and down while moving up in that direction. And that's where we are. The good part is I think we've started to see business coming back a bit. Same-store sales growth was, I would say, low double-digit negative when we started off FY25. By the time we exited the quarter, we are into almost zero, touching distance of zero on same-store sales growth. We had tempered outlets a bit, but we remain confident of hitting the 1,000 outlets by FY28.
Okay, all right, Mr. D'Souza. Appreciate you joining in. Thanks a lot for giving us those details. We look forward to having a chat with you as the year progresses. For the time being, we'll take that guidance on board. The stock is down close to around 1.5%, but actually it's recovered considerably from the low point of the day. Well, let's slip into a short break. When we come back, we'll focus on the technicals of the market. Sachidanand Uttekar will be joining in.